Investment psychology and behavioral finance are two topics that are counter-arguments for the efficient market hypothesis. The belief that markets are efficient and humans are rational isn't necessarily the case. In today's video, we want to talk about some behavioral tendencies, or some behavioral flaws, I should say, investors undergo in. By being more aware of them, you may be able to avoid them and possibly self-reflect on times in the past where you have engaged in them. The first is forecasting errors. A series of experiments indicate people give too much weight to recent experiences when making forecasts. This happens both in the professional and in the amateur investor. Often this leads to lofty valuations. As the forecasts become too extreme, we see this in markets all the time when analysts have to make drastic revisions after their estimates for a company have been either too high or too low, and this can create volatility in the underlying stock. Another is overconfidence. There's always that one investor or trader who makes a very lucky trade, a very profitable trade, and starts to believe that they are the next Warren Buffett. People in many areas of life overestimate their abilities. Most investors can't consistently beat the market, because to beat the market you have to be above average, and to be above average there has to be people that are average and people that are below average. It is how the statistic works. But most investors believe they are above average and they can beat the market. Similar to a study in Sweden that showed 90% of drivers rate themselves above average. Conservatism. Conservatism bias means that investors are too slow or conservative in updating their beliefs in response to new evidence. This can be seen as confirmation bias. When you're looking for data and information in the stock market, there's always going to be negatives and positives. Investors often have a psychological tendency to look more at the positives if they are long a stock, and to look more at the negatives if they are short. The ability to take on new information and constantly self-reflect and self-correct one's beliefs is often a trait of very successful investors, but this trait comes far and few. To simply say, "I was wrong," is not something most people can do. This is a big reason why trends in stocks don't materialize right away, and then at a certain inflection point, everybody jumps on the bandwagon. Think of the tech bubble, marijuana stocks, bitcoins. These are all examples of that. Mental accounting is a mental game in which investors segregate certain decisions. For example, investors may take very conservative investments in an account dedicated to their child's education, but at the same time may make risky bets with a different account. Investors don't see sources of money as the same thing. Studies show, for example, that an investor will be more than happy to spend their dividends, but are less willing to sell shares and liquidate to cash, even if they are the same amount. This falls similar to gamblers in the casino. If you've ever played blackjack or have gambled in a casino, you'll know that you or others around you tend to get more aggressive with their moves when they are ahead. They see this as playing with the winning money. Rather than their own money, it is the money of the casinos. Another is regret avoidance. Psychologists have found that investors feel more pain when they make decisions that go wrong and were unconventional rather than mainstream. So for example, if an investor was to lose the same amount of money on a blue chip stable company versus a small penny stock, the investor will feel more regret and pain on the penny stock. Why? Because it was a bold move, it was against mainstream logic, and therefore there's less people to blame. Whereas the rationale for the blue chip would be more external, blaming things such as the market, a tariff deal, government intervention, or just calling it unlucky. These are a few behavioral biases of investment psychology. Now that you know them, maybe you can reflect and see that one or a few of them you have undergone in the past. I know I have. We hope you enjoyed this video. Once again, give us a comment, like, and subscribe, and happy investing.